What a time to be alive. If you've been a keen observer of this channel over the last 2 weeks, we were waiting for a strong move to the upside after the March OPEX. March OPEX was Friday, and here we are, the Nasdaq 100 gaining more than 2%. And for all of the longs and bulls that bought the lows, you're welcome. And for all of the bears, I told you so. But with tariffs off the table or narrower than expected for now, economic data and the economy being a lot more resilient than anticipated, will this be enough to sustain the rally? Or is this a dead cat bounce that the bears are looking to sell into? This is the question we will answer today, because it's not all sunshine and rainbows. 23andMe filed for Chapter 11 bankruptcy today. The stock was down 60%, and this tells us things under the hood are not quite as rosy as they seem. So where do we go from here? Do we go up? Do we go down? Should we trust this rally? And is this the end? We've got a lot to talk about. Let's roll the tape.
Welcome everybody to the daily recap show where we talk about stocks and the financial markets. My name is Chase. If you like this video, please subscribe, hit that notification bell as well as the like button, and leave a comment for the algorithm. Let's get into it.
This is the daily heat map of the S&P 500, and US stocks closed near session highs on Monday as investors welcomed reports that the next wave of President Donald Trump's tariffs will be narrower than expected, as well as some upbeat economic data. A very green day across the board, led by growth, led by cyclicals, led by mega caps. You could see a Tesla up 11% on the day. Very, very strong day. We saw discretionary perform very, very well. Walmart, Costco, Home Depot, Amazon, they were all up in excess of 1%, 2%. Amazon up 3.5% on the day. Very, very strong trade. We saw Apple and Nvidia and pretty much all of technology do very, very well. Hardware deep in the green. Google was up 2% today. Meta was up nearly 4%. We saw stuff like Netflix, Oracle, Microsoft. They all outperformed, relatively speaking. Financials, also a very, very green day, led by stuff like MasterCard, Visa, JP Morgan, Berkshire Hathaway. And then we saw churn in the defensive sectors overall. Stuff like healthcare technology. Healthcare as a whole was kind of flattened down. The growth components of health technology were green, stuff like Eli Lilly. But look at consumer staples, right? Flattened down. Look at utilities, very, very mixed trade. And today was really just a rotation out of defensives, out of safe havens, into the broader market, into risk assets. And we saw the S&P 500 gaining 1.79%, led by discretionary and technology. Utilities, the only green sector, as well as gold. So risk off sectors, safe haven sectors did not do well. Staples gained ever so slightly, up 0.09%. But I'm sure if you exclude Costco, Walmart, Home Depot from this list, you know, the broader staples sector was very, very red. Energy, healthcare, real estate, materials all gained today. Every other sector gained. It was a very positive day for large caps, mid caps, and small caps too. The underperformer was just large cap value, gaining just shy of 1%. But what we really saw was growth outperforming core and core outperforming value, and actually small caps outperforming mids and large caps as a whole. Small cap growth was up 3.14%, and this outperformed mid cap growth and large cap growth. But really, today was just a risk on day across the board. No matter where you were in the market, you literally saw gains. It was a very, very positive day. It was also positive globally. Canada was very, very green. North America was green. South America was kind of mixed, but Australia was green. China and India were green. Europe was kind of mixed though, and that's because a peace deal in the Ukraine is taking a lot longer than expected. Zelensky was on the peace deal, off the peace deal. Donald Trump said he was minutes away from signing a mineral deal. Zelensky said some very contradictory stuff on the weekend. We're going to cover it in the FinFluential media in specifics, but all in all, mixed trade here in Europe on the back of what was a very good day globally, particularly when the US is green. You know, global stocks as a whole are doing very, very well. Now, the reason why stocks did so well was simply because of the fact that Trump said he was going to scale back tariffs. They're going to be narrower than expected, simply because he says he's going to give countries a break because they've charged the US so much they couldn't take reciprocal tariffs. So instead of, I believe what he's kind of alluding to, instead of just going reciprocal tariffs on April 2nd immediately, I think he's going to scale them up. But I would take everything he says with a grain of salt, because in the midst of scaling down tariffs, we did get this piece of news right here. I thought this was going to derail the market momentum because we got this very early on in the day. Trump announced today that he will be putting on what is known as a secondary tariff on the country of Venezuela. Now, he goes into his reasoning right here, but pretty much a secondary tariff is a tariff on Venezuela and any other country that purchases oil or gas from Venezuela. That country will be forced to pay a 25% tariff. Essentially, if Canada is going to buy oil from Venezuela, they're going to get a 25% tariff. Now, I don't know if that's just a blanket tariff. Trump does go into his reasoning, but stuff like this can shake up the market into the week. So guys, don't just expect stocks to rally because tariffs are scaled back. Tariffs are scaled back for now. Anything can happen this week. Last week, we didn't hear much of tariffs. I think we're going to hear a lot of tariffs this week as we approach that April 2nd deadline, which is Tuesday or Wednesday next week. So we're about a little more than a week away. And at the end of the day, guys, tariffs are here to bring investment to the US. And that's what we've seen. Rolls-Royce explores shifting engine making capabilities to the US to counter Trump tariffs. We also got a $20 billion investment from Hyundai into the US. So all of that helped the markets move in the right direction. We also got some very positive economic data. The composite PMI reported 53.3. The forecast was 51.5. So we actually beat expectations by a lot. So all of these things together saw stocks rally. Some of the outperformers today, AMD jumped more than 6% on the back of tariff news. However, there was some big losers today. 23andMe, the genomics company, filed for Chapter 11 bankruptcy protection in a bid to sell the company, while also announcing the resignation of its CEO following failed takeover bids. Stock was down 60%. Now, this is a company that has 15 million DNA tests. Now, there is plenty of implications for a company like this. For example, an insurance company, right, could actually use the DNA in their insurance claims. There's 15 million Americans, or I think people around the world, specifically Americans, have actually used 23andMe. And that's just a fantastic pool of assets that you can get at an absolute discount. Now, Tesla was up 12% on the back of the tariff news, but there was also this going around Twitter, pretty much ready to stick it to Elon and short Tesla. This is how you can make money from Tesla stock going down. Get a brokerage account, deposit as much money as you can, go to Tesla, buy put, select June 20, 2025, $100 strike for June. That's crazy. And then buy as many contracts as you can. They are $130 each. If Tesla's at like $250 now and keeps going down, you're making loads of money straight from Elon's pocket where it hurts the most. And the second you see retail doing this type of thing, right, that is the bottom. Tesla up 12%. Many people got squeezed on the back of this trade. Now, I don't know if this is official or not, but this was definitely going around Twitter. But for all intents and purposes, guys, we saw 4,200 advances, 1,900 decliners. We saw inflows pretty much everywhere. The S&P 500 was up, inflows in the New York Stock Exchange, slight outflows in the Nasdaq, but we do know that we saw inflows in the mega cap names. And then market momentum finally catching a break. We saw the 5-day moving average in the green, as well as the 20-day moving average. This is what you want to see. It starts with the shorter term moving averages and then moves up. We also saw great improvement across all of the moving averages. This is how breadth thrusts occur, and we just now need to see a continuation from the 20-day to the 50 to the 100 to the 200, but we'll take it one step at a time. And guys, looking at the charts, stocks as a whole gained. The S&P 500, the Nasdaq 100 was very positive, but the best performer being the IWM as well as mid caps right here. The S&P 600 up 2.5% as well. So we really saw the smaller size of the market outperform, but the broader large cap space, look at the RSP, only up 1% relative to the S&P 500 and the Nasdaq 100. So we really just saw really money flowing into the S&P 600 mid caps as well as large caps, and then that middle component of large caps still performing very well, not quite outperforming relatively speaking. Growth outperformed value, and you could see here exactly what we called last week. Spot VIX is lower than the front month VIX, telling us that near-term volatility is less than longer-term volatility. This is exactly what you want to see because the future is uncertain. The second you have the spot VIX higher than the front month VIX, normally that turn in equity markets comes around the OPEX. March OPEX, the big quarterly OPEX, was actually on Friday. And that is why we're seeing this move off the lows here in the equity markets. It's actually kind of what we called, I've been saying that for 2 weeks. I say, hey, this volatility we're seeing has an expiration date. That expiration date is the OPEX. And now we're moving up here on the Monday on the back of some good tariff news. You love to see that. Now, guys, when you have tariffs being narrower than expected, that's going to bode well for the economy as a whole. And that is why we saw yields rise. Yields typically rise in great economic environments. And that is why we saw yields rise. And because yields rose, bonds fell, right? So people were selling bonds, yields ticked up as a result, and the money in bonds rotated into equities. That's literally what we saw today. A rotation out of bonds, out of defensives, out of safe havens, stuff like gold, into just the broad equity markets. And due to the inverse correlation we see with bonds versus yields rose. And this is an indication that the shorter term and longer term economic environment is a little bit more favorable than what it was on Friday. Now, looking at equities as a whole, the S&P 500, the gamma flip zones didn't move up, but we are at the top end of the range. This does tell us a couple of things. Number one, because we actually found a little bit of resistance, you see this candle right here, bears did come in a little bit at the top end of the range and probably added some shorts right here. We also probably did see a little bit of profit taking. And like I said last week, Friday, for this move to be sustained and continued, we need to go ahead and break the 5,700 area. That's exactly what we saw. We are at the top end of the range and the gamma flip zones didn't move up. Now, I do think they're going to move up tomorrow. Generally speaking, the next couple of days after the OPEX tend to be light option volume days. So I think we should see these lines move up over the next couple of days. I think the gamma flip's going to move up, the put support's going to move up, and the core resistance is going to move up. But in the here and now, we have to trade the plan. And because we are at the top end of the range, we can see a little bit of a digestion as well as a little bit of a pullback here from these highs. However, if this does move up, it does mean we can actually go higher. So do expect that. The Nasdaq 100 does have a little bit of room to run to the upside, guys. As you can see right here, we're not quite at the top end of the range. And so what I am expecting over the next week, over the next couple of days, is maybe some outperformance in the larger cap space, the tech space, and mild underperformance in the S&P 500, but still for us to gain net on this week. And based on all the positive developments we saw today, we should see markets as a whole gain this week, particularly to the end of the week. Now, the markets put in a bottom exactly as I said they would here in the Nasdaq 100, as well as the S&P 500. We were pounding the table to buy at the 5% level right here, as well as the 10% pullback level. And those that did add at these levels, right, you're sitting on hefty profits right here, and you're going to be break even on this level very, very soon. Also, because the economic data has been very, very positive, generally speaking, once we get a 10% pullback, if we don't get a recession, if the economic data doesn't continue to deteriorate, we generally actually put in a low right there and then move higher in stocks most of the time. So we're doing what is historically normal, and this shouldn't be a surprise to anybody. It's why I was pounding the table to buy last week. And that's exactly what markets did today. However, I do think we're going to see strong support at this 5,700 area. And I do think we are going to see a little bit of digestion of today's move tomorrow and potentially Wednesday. So if we do pull back, if we do see a digestion day or two in the S&P 500 and markets as a whole, that is completely normal. But if we do continue the face ripper rally, that is also normal. So what I would say is right now, guys, you just want to hold the equities you have. We're going to see a couple of days of digestion, and then we're going to continue the move to the upside in the S&P 500 and the Nasdaq 100. Now, the RTY is an outlier because the core resistance and gamma flip zones actually moved up, meaning there is a little bit of upside to get to the 2133 level. So do expect a little bit more upside here in the higher beta component of the market, the RTY, and stuff like the S&P 600. Now, guys, very, very interesting. When we look at gold, for the most part, we saw a little bit of a pullback here in gold, and I really want us to pull back a little bit more. Guys, the US has been accumulating gold. Last month, 2,000 tons of gold came into the US. 700 of those tons went into the COMEX vaults, which means 1,300 went into the Fed's vaults. The Fed is accumulating gold ahead of Donald Trump and Scott Bessent revaluing the price of gold. I think they're going to revalue at the 2,700 level. I know Scott Bessent came out this weekend and said, hey, we don't have any plans for that. But the Fed buying gold goes completely in the face of what he said. I think we're going to see the Fed and the Treasury accumulate gold over the next year, maybe the next 18 months, and then we're going to see a strong revaluation of gold. And for us, we want to be buyers here at the 2,800, 2,700 level. But ultimately, right here, this is my high conviction spot for gold. If we get there, if we pull back there, I hope we do, you want to load the boat up with gold. Now, let's actually have a look at Bitcoin right here, guys. So we got the chart. We're going to make this a line chart, and we're going to add the FinFluential M2 money supply indicator. You guys can actually go ahead and download this indicator yourself, and then you can just go ahead and offset it by 107 days. And you can see right here, if we do that, Bitcoin and the M2 money supply are correlated very, very closely. It's not a one-to-one correlation, but they are correlated very, very closely. You could see the up move here, the sideways trade here, the up move here, and the pullback we've seen. Now, what we are expecting for Bitcoin is a little bit of a pullback back to the lows that we saw right here, a little bit of churn, and then around middle to the end of April, we should see the face ripper rally. Essentially, what we are looking for right now is sort of like a churn in this zone right here, and then a move onward and upward, potentially retaking all-time highs in Bitcoin. This is the place where you want to start accumulating Bitcoin, particularly if we get back to this low 80s, high 70s area. Bitcoin looks like a buy. But for all intents and purposes, guys, in the S&P 500, the second these gamma flip lines move up, you want to buy the dip or any pullback we do get. There's room to run in the Nasdaq 100, but again, you just want to be buyers of dips. We're in positive gamma, so you want to buy dips, sell rips, and ultimately you should already be long, and you just want to hold until we get back to all-time highs. Will it happen? I don't know. We'll take it day by day. But right now, you just want to sit through the digestion days we're about to have, and you definitely don't want to miss these days to the upside. Stay invested. Don't get shaken out by the volatility. A lot of the bad news is behind us. It's onward and upward, and now we're just waiting for the good news. I think we should see outperformance from the Nasdaq 100 and the RTY, underperformance from the S&P 500, but equities and risk assets as a whole to gain this week. So,
and diving into sentiment, this is CNN's Fear and Greed Index. And guys, we are at the precipice of extreme greed and extreme fear. Now, just last week, we were closer to this level right here. So we have actually seen a little bit of improvement in the overall fear and greed complex. And we are on the precipice of the fear zone. That is largely constructive, considering that we are looking to form a bottom in the S&P 500. Nonetheless, we are in extreme fear, and this is still an opportunity for us to buy, to enter into the greed and into the extreme greed zone if that does happen. Now, part of the reason why we've seen such fear come into the market actually has to do with earnings. We've seen earnings come down in a very tangible way. Now, earnings growth for calendar year 2025 is still double digits, still 11%. Now, at the start of the year, we were looking for 14% earnings growth. So we have actually seen a decrease in earnings, and most of that coming from Q1 and Q2. Year-over-year growth in Q1 was expected to be about 12%. We've seen a revision to 7.1%, and very much the same year in Q2, revised down to 9.4%. However, you do have to look at this in aggregate. We are still expecting earnings growth, and we are still expecting very, very vicious earnings growth in the third and fourth quarter. So until these estimates right here get to like mid to low single digits, I think all dips in the S&P 500s to be bought, and nothing about the macro right now is telling us that we're actually going to get there. I think this is going to be the bulk of the earnings revisions we get, mostly because I think tariffs, if they do come in, is mostly going to be a one-time hit to the overall price level. Now, looking at valuations with regards to the earnings, so earnings are being revised down, but US equity estimates in terms of valuation trading at about 20 times, and then most of Europe, excluding Switzerland and France, is actually trading below 15 times. So Europe looking very, very attractive. And just for the record, if we look at Q1 earnings and Q2 earnings, Europe and the US are roughly growing at about the same 5 to 7% range. It's just that when you look at the US valuation compared to the rest of the world, in some cases, the US is trading at double the price to earnings ratio. And this is where Europe begins to make sense in the grand scheme of things. When, hey, I can get something for cheaper, growing at roughly the same for the next 2 quarters. Maybe quarter 3, quarter 4, we see upward revisions in Europe, downward revision in the US. And then that is how Europe can begin to look better and why Europe can work over the next couple of quarters, maybe in the next year. So for those of you that are diversifying into Europe with names such as NVO, with names such as EVO, Evolution Gaming, Novo Nordisk, that is prudent because the valuations of these stocks are actually quite attractive relative to their growth profiles. But until we actually get a recession, do expect the equity markets to probably put in a low right here. Now, generally speaking, what we see is when we do get a pullback, if we don't get a recession, we normally trade sideways, right? And then we'll make the next move up and resolve higher. However, if we do get a recession, generally speaking, what we see is we trade sideways as well, and then we continue to trade lower with the average return about negative 15 to 20% if we get a recession 12 months down the line. But if we don't get a recession, we tend to resolve higher when we do get a correction. I don't think we're going to get a recession. The Fed doesn't think we're going to get a recession. And we do need to play our cards as that and look at this as a dip buying opportunity. But we do need to sit through the volatility. And when we look at the major macro drivers, stuff like the New York Fed's nowcast, it doesn't scream recession just yet. The New York Fed is predicting a 2.7% GDP growth for the first quarter. Now that is down from the 3% we were expecting in the middle of February, but we're not screaming recession just yet. And at the end of the day, guys, the hard data is still highlighting quite a resilient US economy. Housing starts still above the 1 million mark. Factory output actually increased quite a lot in the past month. Job openings, yes, have been trending down, but they're still at or near the 8 million mark. And we're still seeing in excess of 1 job per employed person. And non-farms also looking rather robust. We printed 151,000 in non-farm payrolls last month. The expectation was for 155. So yes, it was softer than expected, but it wasn't as bearish as some was expecting. Bloomberg estimates coming out and saying we're going to get a 65,000 print. So the hard data is still looking very, very good. However, the soft data, stuff like the surveys, not looking that great. Now we'll see if the hard data, which does lag a little bit, translates into what we're seeing in the soft data, but that is over the next couple of months. And in the year and now, the hard data as well as the Fed's tracking estimates looking rather robust and still pointing to a resilient economy. Now looking at earnings for the rest of the week, tomorrow, Tuesday, we have GameStop after the close. That's really the big name reporting. Then before the open, we have Canadian Solar, Rumble, McCormick, very solid names right there. And then that's really it. We have quite a number of names on Wednesday, but we'll tackle that in tomorrow's video. And then looking at data for Tuesday, the big data is going to be obviously consumer confidence from the conference board. We're also going to get their LEIs, and we'll tackle that in tomorrow's video. And then we get new home sales year over year, month over month. Now we're looking for 660,000 in new home sales, a 0.5% increase on a month over month basis. Consumer confidence to come in at 97.4. And that's really it. Some of the high impact data comes here on Friday. But if you've made it up until here, thank you so much for watching. If you like this video, please subscribe, hit that notification bell, as well as the like button, and leave a comment for the algorithm. Cheers.